Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Well, this is going to be a fun one today. We're going to have a lot of good times. I'm actually stepping it back a little bit today. I found that I have a tendency to get a little aggressive with some of my teaching, so I thought it'd be fun if we just kind of did something a little lighter today. A little lighter.
Good to us.
What do you think?
All right. So it looks like we're actually a few minutes behind at this point in time, so we'll go ahead and kick things off. I wanted to thank everyone for joining us on this afternoon's webinar. So Mark Sebastian will be hosting today's session, and he's from Option Pit. He'll be teaching us how to use non-directional ETF trading using ISE spreads. Mark is a former market maker on the CBOE and the American Stock Exchange. Along with his role directing the path of education for Option Pit, Mark also trades privately. He started the popular option blog Option 911, which is also the Option Pit blog. So now we're going to go ahead and turn it over to you, Mark, and we're going to start the presentation. And if everyone can just make sure to mute their lines just so we only hear Mark this afternoon. Thanks.
Yeah, no. So how's everybody doing today? Good? Bad?
Fine, real good.
I can hear. You don't have to answer verbally. You can just reply in the Q&A or in the thing. So what we're going to talk today is about non-directional ETF trading using ICE spreads. So this should be a really good, a really interesting topic because I'm going to try and hit this from a more visceral level because I feel like a lot of people know when to throw on a condor, but a lot of people don't know when not to. You know, when I was getting married, my father gave me a really good piece of advice. He said, "Mark, the number one way to stay out of trouble and have a good marriage is to avoid problems." And that's not just true in marriage. It's true in raising a kid. It's true in high school and college and in trading. Okay? But what I found is a lot of people don't know what to look for, as in what's a bad sign for a trade. I mean, how do you know whether a trade is a bad idea? You know, it's interesting. You know, we all had that friend back in high school or college where it was like it was like the sinking ship, you know, and if they thought it was a good idea, you knew it was a bad idea. I don't know if that makes sense, but I'm sure. Anybody have friends like that? I'm guessing, where you know, you could see the writing on the wall, you know, or we see out with our kids. You know, we know that they're just about to make a terrible decision. Well, if traders had that foresight, they would probably save themselves a lot of money, and so that's kind of what we're going to go for. Okay, so all right. How do I switch slides on this thing? On the
Mark, you should just be able to click through right up top there.
Is that button right there?
Yep.
Oh, I see it. Sorry.
Okay, you're all
right.
away.
There we go. I got it. All right. So believe it or not, I usually just share my desktop. This is my first time doing it with this thing. So why do we trade? All right. Now, there are a lot of people out there telling you that trading is easy. Okay? If trading was easy, there wouldn't be 134 people sitting here listening to me talk. Okay? It's clearly not. All right? So we are out to make money, but trading is not easy. Okay? You can see there's baby's first profits. I found that when it comes to stock picking, my 15-month-old is better than I am. So if he says "ga," that means buy. If he says "gu," that means sell. And you know, he's been hitting with about a 65% rate. So I've been pretty impressed. So I'm calling from All right. So, the reason why we trade is to make money, but making money is not easy. All right. So some trading myths. All right. I'm about to burst some bubbles here. All right. Trading one. Myth number one. You don't need to understand how options work to make money. All right. Now, that doesn't mean that you can't go through periods of time where you make money not understanding options. But if you give me enough time to take the other side of your trades, I will take you out. You will end up buying me the nicest steak and lobster dinner that they can sell in the city of Chicago by the time I'm done with you. And not just me, my wife, my kid, my parents, her parents, the whole family. Okay? I paid for my wedding because people that didn't know how to trade were taking the other side of my trades. Okay? I was taking the other side of trades of people that didn't know options. Okay? Here's another myth. Trading is simple. Just follow these simple rules. Okay? I think trading is kind of like parenting, if you will. There are so many different ways in which you can raise your kid. And anybody who's got multiple kids, I don't, but I hope to someday, will tell you what works with the first kid doesn't necessarily work with the second kid. And what works with the second kid definitely doesn't work with the third, and so on and so on and so on. Stop me if anybody thinks I'm wrong. Okay? If I'm wrong, please fly to Chicago and teach me how to be a parent. All right? Because you will, if you just were able to unilaterally apply the same method and it worked perfectly, I'll be your option guru, you be my parenting guru. We'll all be buddies. So no matter how good the plan, traders should never just have rules is key. I muted there for a second. Can you hear me?
I'm sorry?
Yep, we can hear you. Sounds like you were just muted for a second there, but you should be back now.
Okay, good. All right. So, and if you hear me talking, if you hear this nasally kind of stuffed up drone, the only person I would possibly be talking to is Katrina, so no need to respond. So trading is simple. Just follow these rules. All right, that's just not true. Again, if trading were easy, everybody would do it. You got to remember that. All right. Now, and this is the one that I think kind of blows me away. Trade the same trade every month. Over time, you will make money. All right. How in the world does that make sense? All right. It doesn't. All right. Trading, you know what? You may actually make money. All right. But you'll never beat your commissions. You'll never beat. You probably won't even beat a bank account. Okay. I think if theoretically, if you trade the exact same trade over and over again, you end up making the risk-free rate. So you basically make what treasuries make. So if that's your goal, congratulations, you can trade the same way every month. All right? So it's not a way to make, there's a lot of people out there who say, you can make 5 to 15% a month. Easy. Trading the same way every month. All right? That is just not true. All right? I hate to call it a lie, but what I would say is that it's intellectually dishonest. Okay? It doesn't make sense. So if you remember this, all right, this should not stop you from trading, all right? Because there are 138 people in this room listening to me. There are about 50 million people watching infomercials, watching all the other things out there, all right? And what they're doing is learning the wrong way. You're listening and learning the right way, all right? So you maybe will never be as good as I am, but what you will do is be better than all of them. That puts you in a very, very good position. All right, truths. All right, trading is hard. All right, there is no easy way out. All right, there are no foolproof rules or systems. All right, there's one thing that can put an option trader at an advantage, though, and that's finding an edge. Okay, now when I was a market maker, what do you guys think my edge was? What was my edge? Write it in the chat. All right, when I was just a market maker. I see one correct answer. Not as traders. Yeah, I mean, what was my edge as a market maker? And somebody said no commission. No, I actually probably paid more per trade than you did, believe it or not. It's called the bid-ask spread. So if I pull up, this is LiveVol Pro, here's FCG, which is the first trust. I'm going to have to share my desktop real briefly. All right. FCG is the bid-ask spread. And if you look, FCG trading 22.56, the bid-ask spread on the May 22 calls is 70.90. All right. So theoretically, the May 22 calls might be worth 80 cents. So if somebody comes in to sell me 100 of the May 22 calls, and I buy them for 70 cents, and the market is 70 at 80, or 70 at 90, okay? So I bought 100 of these for 70, and they're worth 80 cents. That's 10 cents 100 times, which is 10 cents times 100 times 100. So I just made, in theory, $1,000, okay? That was my edge, okay? You don't have that edge. You do not have the bid-ask spread. But you do have an edge. What do you think your guy's edge is? You like my Lady Gaga pick? We don't have to trade. Deciding whether to trade. Yeah, someone said low volume. No, the key is, yeah, we've got two people that have clearly listened to me talk before. You have the ability to initiate or decide not to trade, okay? And today we're going to talk about deciding not to trade, okay? So your edge is that you can initiate, all right? Market makers don't really initiate. We take the other sides of trades, all right? So I have to react. You get to be proactive. I have to be reactive. That is your edge. Don't give that up ever, okay? Somebody that's telling you to go in and sell a condor every day at 45 days is telling you, you know what? Give up your edge, okay? They're basically throwing you to the wolves. All right? So don't give up your edge. Trading, all right? So the key is trade with an approach, all right? That means you don't do the same trade every month, but you approach trade the same month. The same. You know, if you watch a batter play baseball, all right, he is going to approach the plate. Now, he's going to change his swing for how the pitch is coming to him. But he's going to approach, all right? Trade with guidelines. All right, now what's the difference between a guide? Do not trade with rules. What's the difference between a guideline and a rule? All right, a guideline is a process. A rule implies some sort of infallibility. All right, you don't know, when I was at my old job, you don't know how many people had these trading rules, and then they were shocked when they'd lose money. Yeah, flexibility. They're like, wait a minute, the rule said this. How in the world can I possibly be losing money? Okay? All right? And the fact is that the reason why is because rules don't work. All right? And then, of course, here's my little joke.
Get it on the screen, so he torched me on a telephone.
So there you have it. Okay?
Oh. Hello.
No, you don't have to say hello. Just listen.
What is it?
I'm telling you.
So let's just make sure that anyone who's calling in, just mute your line so we're not interrupting the presentation thing.
Was I the only one that felt like that was like, does anyone ever see Everybody Loves Raymond? Does that kind of sound like that? Or like, you got cycles? Or the old Sprint commercial? All right, so trading income spreads. All right, when trading income spread, the trader is really betting one of two things. All right, implied volatility is too high. All right, the premium the trader is receiving for selling options is overpriced. All right, or they're betting realized volatility is too high. And that means underlying movement is going to begin to slow down. Okay? So I'm going to pull up, let's see, we'll look at FCG again. Okay? So if we look at vols, this is 10-day historical volatility. This is a product called Live Vol Pro. So this is a running 10-day historical volatility of FCG, which is an ISE spread. Okay? So if I'm putting on an income spread here, all right, I'm betting that this is going to happen. You see? I'm going to do what I like to call the old John Madden. Wait till you see this, folks. Edit, copy. So if I'm going to do an income spread, all right, this is realized volatility. I'm trying to pick spots where it does this, not spots where it does this. Okay? The other way is in implied volatility. We're going to do the old John Madden again. And yes, this is how I teach all day. I literally go,
Hey, Mark,
boom.
I'm not sure everyone's able to see your screen. So
Oh, I'm sorry.
yeah,
I just
think
realized.
right now we're still on the presentation right now. So if you can just
Yeah, thank you for that. I keep forgetting. I'm so used to, doing my own presentation.
Ah, there we go. Looks
All
like
right.
we got it. Thanks.
All right. So, yeah, if I'm looking at historical volatility, all right, this is bad. Meanwhile, this is good. So that's one way that we're looking at income spreads. Okay? We're looking for spots where we think realized vol is going to stop. Okay? This is very bad. Okay? You don't even like persistence. All right? Even that is bad. What you want is the underlying to kind of stop moving. All right, now, if we're looking at implied volatility, all right, we want to pick spots where we think, well, one, we obviously want IV to fall, but the key is we want these numbers, okay, to be higher than historical volatility over that period of time. So one thing we can kind of do is I'll actually pick my spots where I think 10-day running vol is going to fall. Okay? You can look at 30-day vol. It's actually much smoother. And you can pick your spots. So, for instance, this might have been an excellent sale, believe it or not, because IV cranked down even as that historical vol was kind of holding up for a little bit. So those are really the two bets that we're making. Thank you very much. Okay? So deciding to trade. It's not as important to know when to trade a condor or a butterfly, which is what I'm going to kind of concentrate on today, as is to know when not to trade a condor or a butterfly. While every trader is different, here's some guidelines on when not to trade a condor or a butterfly. Okay? When not to trade a condor. Okay? A condor, all right, when IV is really low or really high. You know, a lot of people think that condors are a great trade when IV is super high. Okay? Well, yeah, you know, you do want elevated and falling implied volatility. But there's a problem. When implied volatility is really high, okay, what tends to happen as we get this movement down?
Oh, I have to listen to it on this.
Change the pencil on it. I think better red. What tends to happen as you get this movement? Any takers here? Well, you know, what will happen is that you'll get what I like to call the realized volatility can be your downfall. On ISE high and lows, a snapback can occur, all right? There's nothing worse than a snapback. You know, one of the things, if anything, I've discovered is that when vol is really, really crazy high, a lot of times, believe it or not, a credit spread is a much safer bet than a condor, okay? And a much safer bet than a butterfly. So what you want, all right, are kind of these mid-vols. So if I pull up periods of time where butterflies tend to work and condors, it's not at these huge peaks and at these big valleys. Oh, you know what? I need to show my desktop again, don't I? All right. Sorry, folks. I'm showing the wrong screen. That was my kid, wasn't it? Sorry, folks. So what you want to see over 6 months or a year is you don't want to be selling here. You don't want to be selling here. A lot of times it's these times, these kind of middling times where butterflies and condors can work. And you can actually see it in the underlying. If I compare the underlying, I'm going to tighten this up a little bit, folks. We're going to go to 3 months. You can see this was a very easy time to be in butterfly trades. You know, you could have sat there on the 23 fly for an entire month and just collected and just hogged premium. All right? You got beat up if you tried to do a butterfly or condor probably on these peaks. You can actually see it in the price movement. You know, on a $20 stock, you know, a $3 move, that's a huge, huge, huge spike. Okay? That is a huge spike. Meanwhile, we've got, you know, once this thing kind of normalizes, so we're not high, we're not low, we're normal vol. Okay? Again, look, peak, probably not that great of a time. Once it starts to kind of fall off this peak, you'll find that there can be some times to enter. And right here, yeah, you get on that 23, and you're in really great shape if you just even follow the price movement. Okay? Does anybody have any questions on kind of using implied vol to kind of figure out when not to trade? You don't trade these peaks. Any questions? All right. Good. One of my assistants saw this morning. She started dying laughing because she thought this was really funny. This is on the. This is actually off of a trampoline box. I thought that was really kind of humorous. All right, time. Here's actually something interesting. All right, condors should generally not be entered inside of 45 days. All right, the way most traders trade them. What most people would call kind of high probability condors, condors that have a good chance of working. All right, and actually, butterflies should generally not be entered outside of 30 days. All right, and this has to do with the decay function. While many think decay is always exponential. That's actually not so. All right? Decay is actually more, this decay is not always exponential. Okay? This is actually how decay really works. You're at the monies, and this is a very rudimentary chart. You're at the monies. They decay the most kind of between 30 and 0. All right, if you look. Out of the money options, the further out of the money you get, the more linear the trade, the more linear the decay. Okay? So think about that. The further out in time you get, the more linear the decay. So think about it. Okay? Because of that, you actually are going to collect more premium, all right, when those far out options are a little more like at the money than when they're more like out of the money options. So one thing we found at Option Pit, okay, that was kind of the first thing that we did that really broke the mold, I would say, is that we think the optimal time to sell condors is around 60 days and not 45. You know, if you can avoid, and that's a little tidbit, all right? If you can get done with your condor, all right, get done putting on your condor at 60 days, 55 days, a lot of times you can be out of it by 30 days to expiration. Think about that. All right? Now, butterflies are just the opposite. Okay? Butterflies, because of that exponential decay, all right, there's a lot of people that say don't do butterflies inside of 20 days. I'll do a butterfly inside of 20 days. I'll do a butterfly inside of a week if I like the trade. You have exponential decay on your side. Now, do I think that it makes sense to do them the Wednesday before expiration? No. Okay? All right? But given a good set of circumstances, all right, if you can set your trade up the right way, okay, you can do a butterfly up to, within a week. You could do it within 5 days if you want. You just have to know how to set up your butterfly. Something actually I'm not going to go through today, maybe next time. But the key is that 30 days, all right? Don't even, I don't even really start looking at butterflies until about 30 days to expiration.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.